Hi, folks. Welcome to another episode on Freestyling on Finance. Today, I'm going to talk about books which are written about investing and how they affect our behavior as investors. I love reading books on investing. They keep me gripped. They keep me wondering how these people pick up these stocks which are winners, how they see stocks which are not seen by others. They catch them early on, or sometimes let go of stocks which everybody is raving about, but they manage to avoid it. And they also very humbly talk about the mistakes they make and how they recoup themselves from such losses. But how does it affect my investor as a behavior? Practically zero. If you read the latest book by Pulak Prasad, which is what I learned about investing from Darwin, it's such a well written book. The flow is beautiful. He illustrates all the concepts very well. And he speaks about how their process is. As retail investors, can we really learn from this? Now, at one point, he talks about picking up companies at the right valuation. He says that his firm waits for the right valuation and then picks up stocks when the stock hits that valuation. Can you or me figure out this right valuation? I don't think so. It's very difficult for me to go and calculate the right valuation and pick up at that. At best, I could do a simple math saying that, look, the 52-week high was, let's say, 1,000 rupees. Now it's dropped by 20% to 800 rupees. So I'll pick up this stock because it is available cheaper. But beyond that, it's really difficult for me to learn how to figure out valuations, then research in detail about this, and then pick stocks basis that. Now, Pulak Prasad's firm Nalanda Capital has put up all their existing holdings. So I may go there and look at some stocks and pick up from there. But beyond that, I'm not going to do much research. I prefer mutual funds simply because of the ease of investing. I know there's a fund manager there who's researching these stocks, who's has teams of analysts and data scientists, etc., who are helping him or her pick up these stocks, and they deliver a return which is above fixed deposits. I'm comfortable with this methodology. But nobody's going to write a book about people who got rich by investing in mutual funds, because it'll be a very short book. A, invest in mutual funds for the long term. B, do periodic reviews. C, tweak your portfolio when you see a fund underperform for a long time. D, exit when you get a good return and when the requirement is there. So it'll be a very short book and nobody's going to buy and read this, right? It almost sounds like a textbook. No textbook has ever become a bestseller. But some investing books have become bestsellers because they're very entertaining. But as retail investors, we shouldn't just chuck our plan and say that I can also go and pick stocks. Let me go and invest a good amount of money in this and follow it up. Instead, if you're really keen to run a strategy, then you should definitely invest. You should start picking stocks, but probably look at blue chip stocks and invest very gradually. See whether you are able to stay the long course and then add more to your investments. Otherwise, you could find that you're investing money and then you're just letting it go. Sometimes stock prices take a nosedive and you don't react fast enough to protect your capital. Also, remember that if you take a few steps, you already are better than most people. You rise to be an above average investor. And what are these steps? A, building an emergency corpus. B, taking a personal health insurance. C, taking a term life insurance. With these three measures, you've created a buffer for the wealth you're going to create going ahead. After this, set up a certain percentage of your earnings as savings. Be a little aggressive about this so that you end up saving more. Withdraw from it whenever you have a requirement. Don't be shy about withdrawing from it because it is your money. Don't get into a thought process that, oh, these are long term and I shouldn't touch it and somehow I should try to manage without it. No, you can always take out your money and then put it back in if the requirement comes up. Basket it into various requirements. For example, travel can be one, child's education can be another, retirement can be a third, etc. Not because these help you to dramatically increase your savings, but it keeps you anchored. Goals help us to increase our savings or at least continue our savings because we feel that we may lose out on the goal if we don't invest more on this. And periodically review your portfolios. Consider risk reward before you get into different types of investments. But if you really feel strongly an urge to invest in certain investments, go ahead, put a little money and stay the long course. See how it works out over a long term, and then keep adding more to it if it is working well for you. All these steps will ensure that you're an above average investor, and then maybe you can write a book about it. Maybe friends and relatives will read it, or it may be entertaining enough to be a bestseller. But at least you would know that, like those uncle aunties we've heard of who have invested in blue chip stocks much earlier, like Nestle, ITC, etc., and are now sitting on a few crores of rupees. You've also done the right thing by staying invested for the long term and making the right choices. So I hope this helps you in your investing journey. If you have anything to chat about, do drop a comment or reach out to me at my contact points and I'll be happy to talk to you. Thanks for watching.